All right, so in the last part of this lesson, we're looking at some common financial ratios that we can use to study the company. So one of it, I've talked about it before, is the earnings per share. So we want to see that a company has consistently increasing earnings per share. And EPS, or earnings per share, is the net profit earned per share of stock. So again, how do you calculate EPS? You take the total net income or net profit of the company and you divide it by the total number of shares outstanding. So for example, this company has a net profit of $126 million and it has got 150 million shares outstanding. So if you take the total net profit divided by the number of shares, you get $1.26 per share. So again, what does it mean? It means that if you own one share of this company, theoretically, you're entitled to $1.26 of profits for that year. Now, do you actually receive that money? Not always. So how do you benefit? Well, the company can do a few things. Number one, the company could take that profit and pay it to you in cash, and we call that a dividend. So usually out of the profits, the company may pay 50% or 80% of the profits back to you as cash dividends. But again, not all companies pay dividends. If they do, they could do that. Alternatively, the company could take this profit and use it to reinvest in the company by creating new products, by expanding into new markets, by opening more outlets. So by doing that, it increases the value of the company, and as a result, the share price will rise eventually. So how do you benefit? You benefit through capital gain, the increase in the value of your shares. Or the company could also take this profit and they can use it to buy back shares, which is what we mentioned earlier on. So if the company buys back shares, what happens? That's right, the number of shares gets less and less. So when the number of shares gets less and less, what happens? For the same profit, the EPS would increase, right? So in other words, there are two ways to increase the earnings per share. Either the company increases the net profit, and the company reduces the number of shares outstanding, both of which will increase the earnings per share. So ideally, we want both to be happening. Profits should be increasing, and at the same time, the company is buying back shares to reduce the shares outstanding. So again, earnings per share can be increased by increasing net profits and or decreasing the shares outstanding through share buybacks. So let's take a look at some of these numbers on FinViz. FinViz is for US companies. So for international companies, you could take a look at Reuters or investing.com. So on FinViz, I'm looking at Apple, and let's take a look at what we have. So you can see that Apple has a net income or net profit of $55 billion. There's a total profit of the company. And Apple has a total of 4.45 billion shares outstanding. So if you take the total income divided by the number of shares, what do you get? That's right, you get the earnings per share, which is over here, EPS, earnings per share, $11.85. Which means that for every $1, or rather, for every one share of Apple you own, you are entitled to get $11.85 of profit based on the last 12 months. What's the current share price of Apple? Apple is now selling at $265 per share. So let's write that down. $265.58 per share. So this is the share price right now. Okay, so if you buy the share at this price, you'll be getting an earnings per share of $11.85. There we go. All right. So if you divide the share price by the earnings per share, what do you get? You get the price to earnings ratio, or PE ratio, which is over here, PE ratio 22.41. So again, we've talked about this in the first lesson. What this means is that, in a way, you're paying 22 times for every dollar of earnings, which means for every $1 that a company earns in profit, you're paying $22 to buy the shares. So theoretically, if the earnings remain the same, you need 22 years to get your money back, to break even. But of course, that's not going to happen because companies grow. So we expect the earnings per share to grow from $11 to $15 to $20. And that's why people are willing to pay a higher price to buy the shares today. Hence, you have a PE ratio of 22 times in this case. All right, so over here, you can see the PE ratio, which is again the current share price divided by the earnings per share. So in this case, you get 10 times earnings for this example over here. All right, so finally, let's look at another very important ratio that Warren Buffett pays very close attention to, and it's called the return on equity ratio, ROE. So the ROE is equal to the net profit after tax divided by the shareholders' equity. So again, how do we get the shareholders' equity? It's in the balance sheet, right? Total assets minus total liabilities is shareholders' equity. So for example, if the company makes a net profit of $126 million and has a shareholders' equity of $420 million, what is the ROE? It'll be 126 divided by 420. They'll give us an ROE of 30%. So the higher the ROE, the better it is. A high ROE tells us the company is very, very efficient at making money based on what shareholders have invested in the company. So in general, benchmark an ROE above 12% is a good company, and above 15% is an excellent investment. So you want to see consistently high ROE over the last 5 years. All right, so if you go back to Reuters or Yahoo or whatever, you can take a look at the ROE under key metrics. And that would be under management effectiveness. There we are. All right, so you can see that for Microsoft, right? Let me just double, yeah. So for Microsoft, the ROE, return on equity, is 39%. So much higher than 12 to 15%, definitely is a great business. And you can also look at the 5-year average. You can see it's also above 12 to 15%. Now, do bear in mind that there are certain companies like McDonald's, Domino's Pizza, and Yum Brands. When you look at their fundamentals, they have a negative ROE, Now, on the surface, people may say, hey, that's really bad. But in these exceptional cases, it is actually not bad. Let me explain why. Why is that not bad, right? So remember that ROE, return on equity, is the net income divided by the shareholders' equity. Okay. Now, of course, if the net profit is negative, causing the ROE to be negative, of course, that is bad. But for the case of McDonald's and Yum Brands and Domino's Pizza, they are not losing money. In fact, they are making really good money. Their sales and profits are soaring. So if you take a look over here, for McDonald's on the left, you can see that their income, their net profit is $5.8 billion, and it's been increasing consistently. So why is the ROE negative if the profit is positive? The reason is because their shareholders' equity is negative. That's right, they've got negative shareholders' equity. So this is a special, unique case. Now, if you look at the balance sheet of McDonald's, all right, we're looking at the balance sheet, you can see something really interesting. You can see that their shareholders' equity is negative. So why is it negative? Because remember, the assets minus liability equals to shareholders' equity. It's because they've got more liability than assets. Right? If you take a look over here, you can see that their total liabilities is $54 billion. So they owe 54 billion. But their total assets is 45 billion. All right, so you can see that again, assets minus liability equals to the shareholders' equity. So they've got more liability than assets, which means that they've got negative shareholders' equity. Now again, on the surface, this doesn't look very good. This means that if the company were to close down and they pay off all their debts, they have got more debts than assets, which means that shareholders are left with nothing. So technically the company is insolvent, all right? Now this usually happens to companies that are losing money, they're not doing well, and eventually that they go bust. But for the cases of, again, McDonald's, Yum Brands, and Domino's, that's not what's happening. Their profits are going up, their sales are going up. But why did this happen? Okay, it's because these companies, what they did is they've been aggressively buying back shares. And again, by buying back shares, what happens? Right, you have less shares and each share gets worth more and more. So shareholders are happy because buying back shares increases the earnings per share. But by buying back shares, it reduces the cash of the company, which is an asset, and it reduces the shares outstanding. So it reduces these two things. Now, not only have they been doing that, but they have taken advantage of low interest rates. As a result, these companies are borrowing a lot of money from the bank, borrowing a lot of money, paying very low interest rates, and using the borrowed money to buy back shares. Okay, and that is what's causing the earnings per share to go up and the share price to fly. But as a consequence, the debt has gone up compared to the assets, creating a negative shareholders' equity. So is this good or bad? Well, here's the thing. If the company continues to increase sales and profits, then there are no worries, okay? Because we value the company based on its ability to make money. But if one day the company closes down, in that rare scenario, then shareholders get zero, nilch, nothing, okay? And that's the main risk. So having said that, if you find it uncomfortable, by all means, don't invest in these companies. But if it's a small part of your entire portfolio and you think that McDonald's will carry on, Yum Brands carry on, that this is just a short-term technical issue, go ahead. It's really up to you. But just to share with you that this stuff happens as well. All right, finally, let me show you how you can use a Finviz to screen for companies, because there are so many companies, like 7,000 companies in the US. How do we screen for companies that meet these good fundamental criteria? So again, you can go to Finviz, click on Screener. And in the database, there are 7,800 companies. So we like to find those with good fundamentals. So you can click on Fundamentals over here. And you can select your criteria, right? So for example, you can say, okay, I only want companies where their earnings are growing for the next 5 years. It's got positive future growth rate of whatever, right? If again, you want high growth companies, you can say, okay, over 20% growth. If you say, I'm okay with, a moderate growth, you can put over 10% growth, whatever. So if I put 10%, for example, it will screen from 7,000 to 1,400 companies. Next, we can put in an ROE criteria. Say, I only want companies with an ROE of at least 10% or at least 15%. Now, like I said, above 12% is great, but they don't have 12%, so we could put 10% as a filter. So that gives us 500 companies. Next, we can put in the sales growth for the last 5 years. So we want to ensure that the company has been growing the revenue for the last 5 years. So as long as it's growing positive, that's fine. And again, you can specify how high. You can say, I want the company to grow at 20% a year for 5 years. Now, next, earnings growth this year. If you want to look for companies that are growing this year, you can put positive. All right. Next, you can put the current ratio. Say, I want companies with a current ratio of more than 1. I want a company to have positive growth next year. and I want the company to have earnings growth for the last 5 years of, again, it could be positive, above 5%, above 10, above 15. Again, the more strict you are, the less companies you will have. If you're less strict, you've got more companies. So, for example, we could put over 10%, for example. So once you do all that, it will screen down to from 7,000 to 183 companies. Again, if that's too much, you want to be more strict, you can increase the strictness and say, okay, I want companies that are, been growing at least 10% for the last 5 years in terms of sales. And we're down to 97 stocks. So this is a very good way to quickly screen the market to look for very, very good businesses. And you could click on charts over here, and you can visually have a look at the companies being displayed, right? So you can see this is a downtrend, so we're not so interested. This kind of like moving sideways. This could be interesting. This is on a very nice uptrend. It's on a nice uptrend and nice uptrend. All right, so more on that later on when we learn how to analyze the company on all these criteria.